In this video, I'm going to provide a very simple example as well as a general approach for forecasting income statement. Before we go any further, we must answer at least to the following questions. The first is, what do we want to achieve? So being clear about the objective is always very important before you forecast any financial statement. And for this example, we want to find out how much do we need to borrow next year. The next question, we have to be clear about the time span that is being considered. And for this example, we are considering this current period and the next year, which means we have 1 year of data and we want to forecast next year of income statement. The third question we should be clear about is what variables are being forecasted. So in this example, we want to focus on common items found in income statement such as sales, cost of goods sold, operating expense, interest expense, income tax, and net income. The next question we should ask is what level of accuracy do we want? So accuracy comes with the cost and time. So for this example, we just want broad outline, therefore we want some accuracy in the result. So the next question we should be clear is what data are available and what model is being used. We are assuming this is a new company, new firm, so we have only 1 year of data available for us and we want to use percent of sales method. The next question and the final is what variable that have circular relationship are being changed. So in this example, we are assuming that short-term borrowing is being changed in order to make the balance sheet balance so that it will also impact the income statement and the cash flow statement. Once we know basic idea about these questions, the next is we have to make key assumptions about your forecast, and all these assumptions should be very realistic. And in order to make this assumption realistic, you have to go beyond the financial information of the company. You have to also understand the macroeconomic environment, industry environment, as well as the business cycle and where the economy is and at what state the company is operating. But this is an example, so I am making an artificial assumption, but keep in mind that all these assumptions should be very much realistic. So for our example, the first assumption we have is we are assuming next year sales is expected to grow at 25%. In real life, there are different models, different techniques to forecast the sales, but for our example, we are just making an assumption that next year's sale is going to grow at 25%. The next assumption is cost of goods sold as a percent of sales will remain constant. Next assumption we have is operating expense as a percent of sale will remain the same. And the next assumption is interest on the short-term loan and long-term debt are 7% and 9% respectively. And the final assumption we are making for this example is tax rate will remain a constant rate of 21% of the profit before tax. So once we make all these assumptions, now we are ready to forecast income statement. Next, I want to provide a numerical example showing how to forecast different items on income statement. Here I have an income statement. The figures in this income statement are in thousands. It has a data for current year, and I want to forecast values for certain items for next year. There are two types of items on income statement. Items that change automatically with sales, such as cost of goods sold, operating expenses, and items that do not change automatically with sales, such as interest expenses. Based on the type of items, we make assumptions for projection. And I have relisted our assumptions here in column C. And once we make all these assumptions, next we want to go and express certain items as a percent of sales because we need them to forecast values for the next year. So which one items we can express as a percent of sales? Remember, only those items that change with the sales. So in this typical example, the cost of goods sold and operating expenses are changing with sales. So we need to express current year's cost of goods sold and operating expenses as a percent of current year's sales. How do we do it? So let's express cost of goods sold in current year as a percent of sales. So that's going to be equals to current year's cost of goods sold divided by sales in the current year, right? So that gives us 75%, which means 75% of the sales goes towards cost of goods sold. And once we compute the cost of goods sold, next we compute operating expense as a percent of sales. And that is equals to the current year operating expense divided by your sales in the current year. So that gives us 13%, which means 13% of current year sales goes towards operating expenses. What about interest expense? And we are assuming here interest expense doesn't change with sales. It comes from the balance sheet, so we don't need to compute interest expense as a percent of sales. What about income tax? We are also assuming income tax will remain at a constant rate of 21% independent of sales, so we don't need to express as a percent of sales. So once you express these items as a percent of sales, now we can go and compute values for next year. So let's start with how much sales will be next year. As we know, the sales is going to grow by 25% next year. Therefore, next year's value is going to be current year value, right, times 1 plus 25% because sales is increasing by 25%. So if you do this, it gives us how much sale will be next year. So once you know the sales and once you know what percent of current year sales goes towards cost, now we can compute the cost of goods sold for next year. So in order to compute that, what do we need? We equals to, in current year 75% of sales goes towards cost of goods sold. Therefore 75% times next year's sales. So that gives us the cost of goods sold for next year. Once you know sales and cost of goods sold, you can compute the gross profit, which equals to the sales minus the cost of goods sold, right? So that is 1,000. 1,000 is the gross profit. Now let's go and compute operating expense. What do we know about operating expense? 13% of current year sales goes towards operating expense, which means if the operating expense is going to remain the same, that means next year also 13% of sales goes towards operating expense, right? Therefore, it's going to be equals to 13% times next year's sale, and that gives us the next year's operating expense. And once you compute operating expense, you can compute earning before interest and tax, which is going to be equals to gross profits, right, minus your operating expense. That gives us the earning before interest and taxes. Now what about interest expense? So interest expense doesn't change automatically with sales, and we have made the assumption that interest on the bank loan and the short-term debt long-term debt are 7% and 9%, and this comes from the balance sheet, and we don't know how much bank loan or the short-term loan is and how much the long-term loan is. Let's assume that now, for example, that the bank loan was 10,000 and the long-term debt was 30,000, right? So in that case, the current interest would be equals to your 10,000 but the figures are already in the thousand. So 10 times the 7% plus 9% times the 30, which is the long-term debt, right? So in that case, our interest expense would be 3. But remember, the actual interest expense comes from the interest based on the short-term and the long-term debt on the balance sheet. But for this example, I'm assuming 10,000 is the short-term debt and 30,000 is the long-term debt. But I'm going to come back and correct later when I talk how to forecast balance sheet. So once you know interest expense, now we can compute profit before tax, and that's going to be your earning before tax, and interest minus your interest, and that gives us the profit before tax. Now next we compute income tax, which is going to be 21% of before tax income. So that's going to be 21%, right, times your before tax income, and that gives us the income tax. And once you know income tax, your net income is going to be your before tax income minus after tax income, right? So this is how you compute net income. And in this example, we have a very limited number of items to forecast, but in full-fledged financial statement or income statement, you'd have many items. But just to make this example simpler, I made few items here. So based on these few items, you can understand how we project or forecast the next year's item. So the basic idea is you have current year's values and you have your assumption, and you compute the ratios of those items that change with sales, and use those ratios to compute the next year's value using the next year's sales. I hope it makes sense. Thank you.